Ta-da! Okay. Oh gosh, it is the end of February. This is our last Monday of February. So is anyone else just like slack-jawed over the fact that we are 2/3 the way done with Q1 of the year of our Lord 2025, for Pete's sake?
Yeah.
Like, this is unbelievable, right? Time is just screaming by. Um, Last week we talked a little bit about how the market is pivoting, and yet again we're in a different market. And so this week I spent a lot of time talking to agents, specifically about what that looks like, because I wanted to come back and have kind of the rest of the conversation with you guys about it. And here's what we talked about last week. We talked about the market is shifting, and it's in different sectors and almost down to neighborhoods. I want to confirm to you that that seems to be the consensus in a lot of the conversations I've had with agents outside of just our little happy ecosystem here. And so if you're noticing that, massive congratulations to you, because that just tells me that you are paying attention to what's happening in the market and that you have an awareness. And the more awareness that you have around that, the more you're going to understand how to pivot and what to do in that pivot. And so Will actually texted me this morning on something that I go, oh my gosh, see, this is another layer of what we can look at that could be really beneficial to setting up not just your now business, but your future business, but gives you kind of an arm into being able to position yourself so that you start to become this resident expert. And the resident expert is really meaningful if you're looking at today's market saying, gosh, there's so many things that are niched down, right? The riches are in the niches, right? If you can figure things out in the niche, and if you take that and say, gosh, this is an area that I farm, this is a specific sector of type of real estate that I farm, right? You might not be bound to a zip code, but you are looking at the type, like first time buyers, that's your thing, right? Like, you can start to build some of these things. So I would encourage you to do a couple of things. I'm going to ask Will to share in just a second, but I would really encourage you to look at your past business. Let's do a quick analysis of where did all of my business come from? How am I thriving? And then can I take that sector, like the majority of where your business came from, can I take that information and really drill down and go, okay, I could make a niche out of that kind of market? Because I think, and this is just my opinion, but it's based on lots of conversations with agents just like us, who are in the throes of everything. I think if we can focus on really honing skills in one or two areas instead of being the jack of all trades in this business, do you agree that you have to, Michael mentioned it last week, I say it all the time, we're everything from the janitor to the CEO, right? You're your own marketer, you're your salesperson, you're your lead generation person, you're your operations person, you're your finance person, you're your customer service person, you're your paperwork person. Like, that's a lot of like psychotic personality disorders all combined together to make an effective real estate agent, right? And so if we can say, gosh, is there a way we can sift through some of this and get really, really good at one or two or even three things? Because I think if we have three things, I think and this seems to be the magic, right? If we have three things, any one of those things would allow us to pivot in any kind of market condition, because someone in any of those, whatever your three are, they're not going to be so closely threaded that you'll be affected. It's basically making yourself inflation proof in a way, right? So if you can get good at two or three things, and you can get really good and you can build structures and systems and automation around each of those three things. And I know it sounds a little overwhelming, but stick with me. If you can do that, I think you're future proofing yourself, because I think if you do that and you have things in place, all you have to do is when things shift in the market, you just have to tweak a little bit to adjust instead of throw it away and start at zero. The market is ahead of you. You're chasing the market. You can never get caught up to get ahead. So I think if we're honest and we look back at our careers, I would say the majority of agents have been in that scenario. Oh my gosh, I should do this because this is what's happening in today's market. So I hurry and I do this creation of something, but I'm already behind the eight ball because everybody else that's succeeding right now thought of it way back here. And so if we can say, hey, what are the things I love to do? What are the things I'm actually really good at? And what do I have an interest in? Because I think you need to have those three pieces before you can get excited about putting in the work to build the systems and structures. If you can build the systems, structures, and automation around those things. And by that, I don't even mean like a 700-point process. I mean, start with a 10-point process for everything and build it as you go, but get a framework. And I think if you can do that, I think then you future protect yourself for as the market shifts, because we've been talking about how this market is different than 6 months ago, and it's honestly different than 2 months ago. And I'm willing to put money on it, and I put a lot of money on it, that in a month and a half to 2 months, it's a completely different market. If you start right now looking at what that could look like, you have a head start on being able to pivot and not be sitting here going, gosh, how am I going to find business? Because everybody's passing me by. So I really wanted to encourage you, because I continued the conversations that I had last week around these things, to really look at it like that and say, hey, where can I get really good at it? Even if you haven't done any business in a sector of the market that you're super interested in. Let's think about that for a second. Maybe you have never worked with first-time buyers. And you're like, but I kind of want to, because that's kind of my heart. I believe in home ownership. I think, like, whatever your reason is, but you just haven't had the opportunity because no first-time buyers have come your way. Get the other two sectors where they're generating business, and then start building on the one you want to learn about and know about, right? For one thing, there will always be first-time buyers. There will always be move-up buyers. There will always be move-down buyers. End of story. Those three things are never going to change in our industry. The other niches are, investor people. Some of our current clients that hit those three marks are going to also want to invest. Some of the people that want to invest don't want to do anything in those other three, and you're leaving money on the table when your services could be utilized. There will always be first-time buyers. So get to know all the first-time buyer loan products, right? Find out where they can find out the neighborhoods that are most conducive to an entry-level buyer, right? There's ways to do this. If you want help, we'll coach you through that. But my point is, I think we should be looking at what we can sector out, what I want to do, how I want to build my business. And then I'm not kidding you, it just needs to be a simple framework to get started. It's not overwhelming. And so I would encourage you that. So I'm going to ask Will to share like what he has done the research on and has some really good information about, and an opportunity for us as entry level before it goes to market opportunity. So I'll just be quiet and let my friend Will share.
Thanks, Kimberly.
Yeah.
So you said the way the market shifts, and we gotta just be ready to pivot. So I always look at my business two ways: my long-term plan, which is my sphere of influence, building my sphere of influence, doing all of that, and then what's the market right now that's giving me now business. And I got a couple of those things. Like right now, I'm a Dave Ramsey endorsed local provider, so that gives me some now business. During the crash days, I got an REO account that gave me the now business in that market, or the short sales, that was the now business in that. So I always look at that like, whatever the market's doing, we got to pivot to that and do that. But we got to continue our long-term goal, which for me is building my sphere of influence and building that forever business. I've done a deep dive into what Sharon does, and I've been watching podcast after podcast, probably 100 of them in the last month. And listening to all the stuff that he's talking about getting yourself there where people know you and you're the go-to guy, and you're like the hero of that neighborhood. So as I'm doing that, I'm like, okay, how am I going to do this on social media? What's my platform going to be? Well, I'm a true believer that when you start thinking like that, something shows up. And so I have a friend that's been in this business for a long time, and she's working with a company called Town Sites. And what they do is they create a town site for you that you like. I'll tell you that I bought Tempe, Chandler, and Ahwatukee. And so Can I share my screen here? I'll show you what it
Yeah.
looks like.
Yep. Go for it.
Give me a second. Do I just click on share?
Yep. It should be open for anybody to share.
And that's gonna be
And I think it's unkind that you start with Temecula, since you know that I'm just a wine girl that loves that whole area. Thanks a
Oh,
lot.
yeah, sorry about that. Yeah, so this is just one sample that they had that's already up and going. So what the premise behind it is, you create this town site, whatever it's going to call, like, everything Awatuki or something like that's what mine's going to be called. And you get your sponsors, you get your lender to help pay for it. You get if you click on the local directory here, you get a bunch of different businesses, your plumber, your HVAC. So anyway, you're gonna put everything in there, and then they're gonna create articles about that area, what's going on in the neighborhood. And so they're using AI to create a bunch of this stuff. So basically all you have to do is manage it where you're telling them, hey, this is what's going on, this is what's coming up, and they'll create an AI article about that and run that for you. And there's a couple different um, packages, like one's like $500 a month for just the basic. Here it is. You have at it, create this thing for yourself. And there's one that's $1,300 a month where they're actually putting money behind promoting the site, where you get people to sign up and watch your newsletter, because it's a newsletter, an email that goes out once a week that brings them back to this site. And so I was like, man, this is going to be a really easy thing for me to start all this planning that I've been doing and learning, where now I have a place where I can put this and start creating. So my vision is to do the articles, but also I have Tempe, Chandler, and Awatuki, where I'll go, maybe the mayor of Chandler, and say, hey, I've got this great site and it's got a lot of views. I'd love to get an interview with you to share it on there. Or, again, all the stuff that Sharon says, local business, that's a big business, maybe it's Intel, and I can get someone from Intel to come talk to me about what their plans are, and just getting out there and making it feel like, hey, I'm the expert in this area and I'm the one that's giving you all this information. And the other thing my plan is, I've already got some businesses that said, hey, I'll give you some coupons that you can put on there. So what I'm going to do is I'm going to put it out, hey, if you want a coupon for this business or this business, just send me your information. I'll email it to you. So that way I'm collecting more information from them, from that community, where I can put them on the mailing list.
So good. So good. And so you said this package is like $500 a month?
Well, yeah, I think it's $500 a month just for, here's the basic thing, and you kind of do the work, and it's $1,300 a month, and they'll create the AI articles for you. They'll do all of this stuff for you, and you give them a list of your vendors who you'd like for them to contact for you, to ask them to be on here. Like I already have a lender; he's going to pay $500 a month for it, and then I have a mover, a plumbing company, and they're all going to pay $100 a month, but they'll make those calls for you and get that set up. So that way it's like, hey, I know you're doing a lot of business with him. He's got this great site that's going to go up, and he's looking for sponsors. If you don't want to do it, it's okay, no problem. We can get someone else, but he asked me to call you first.
Yeah,
So you
that's
got like
awesome.
a third party doing it.
That's great.
And it all goes through Moxie, so it's not, it's all RESPA compliant, because it's basically them marketing on this site. They pay Moxie, and then Moxie pays back us for the space that they have on there.
Nice. Nice. Awesome. Well, thank you. So if any of these guys have any interest, they can just connect with you right away.
Yeah, and the lady's here local, so it's basically you're going to be exclusive. Like for me, I'm going to have Chandler, so no one else is going to be able to have Chandler. Gilbert's going to be available. No one else is going to be able to have Gilbert for this site. I know Scottsdale and Phoenix, because it's big, they've got it broken up into different areas of town. But yeah, if you want more information, just message me and I'll connect you with Melissa, who help get you taken care of. And this is going to be across the country, so if you have people across the country that are interested as well, they're just getting ready to start going out to conventions and conferences and meeting with everybody. And I just want to give us a chance to get it before anyone else does.
That's awesome. I love it. Thank you for thinking of us and
Yep.
including us, because I think this is important. I think it's one of these things, you guys, where you go, okay, wait, if we're really going to do this niche scenario and get more presence known, this is such a really good way to do it, and it's not that much money. In a few weeks, I also have Eli from Optimize 5 coming back on to walk through it. And I don't know if you guys remember this, but the end of last year, probably in like October, November, somewhere in there, I had him on to show what they did. And it's basically where they go and they look at every possible site. They scour the internet for every mention of you and make sure that all of your information says the same thing. So like I had stuff, I was with KW in 2004, 5, and 6, I think. And and I still had information from back then on the internet for myself, right? It was ridiculous. And so there was stuff all over the place telling me where I was a broker, all of this craziness. Anyway, they cleaned all of that up. So now if you search me, everywhere you find me, you should find my current information. Everything's exactly the same. I'm not in production anymore. I refer all of my business out right now, but you can put your reviews up, you can all of it, and actually they do it all for you. And so it's a very worthwhile thing, and especially if you're going to dial into niching down in some of this stuff, you want to make sure that when they're searching you, they're not getting all of this crazy information. And I'm telling you, I was on websites I didn't even know about. I had no idea. I don't have a membership or an account, so I really didn't even have the wherewithal to know how to clean it all up. Anyway, that's what Eli does. It's pretty impressive. I'm very thankful I did it. I'm doing it for some other reasons in terms of growing real, but it's the same concept for what you guys are doing with client attraction. Okay, thank you, Will. I appreciate that. I want to move really quickly. Yeah, I'll share. Well, Cindy, Eli will be on in a couple weeks, but I can absolutely share his information with you. Remind me later because I'll forget right now. But yeah, I'll get that to you. Jamie is here from Lawyer's Title. You have anything you want to share with us this morning before we throw it to Michael?
Sure. Good morning, everyone. We did have on the same or similar note what you were mentioning earlier, Kim, is we had the Cromford report this past 19th, and it's the third Wednesday of every month. So I'm going to shoot my info to the chat right now. If you haven't been going or you haven't had an invite or whatever, let me know and I can shoot that out to you and include you on that list. Because it is eye-opening and good to know how to have a pulse on the market. We are in a stabilized buyer's market right now, and it sounds like that'll only be a window for a few more months. We have a lot more listings on the market right now than we've had in the last couple of years. So it just screams to me that our buyer and the buyer population needs knowledge and actual information, that now is a good time to buy. Not the best time to buy and flip, but to buy and hold for 3 to 5 years in that window. And actual buyers, that it's time for them to do that now. They can get the best deals right now. And the lack of accurate information that they're being fed is detrimental. So, but all that stuff kind of comes up on these Cromford market reports. So if you want to be included, let me know and I'll shoot you an invite for this coming month, which is I think March 19th or 22nd, the third Wednesday of March, because it is helpful to know, what's going on. So, but
Perfect.
Otherwise, happy to be here. Thank you.
Thank you. Thank you. Appreciate that. Okay, my sweet friends, I'm going to throw it to Michael. Michael, thanks for hanging out with us again today. Last week was super good. It provoked several conversations that I had with people who were on here, and people who missed it, they watched it in the recording. So if you guys aren't aware, in the Lions and Legends Facebook page, we post the recordings of each of these in there. So if you ever miss one, you can go watch it. If you've missed a whole bunch and you want to go back and scroll through those, you can put them on 3 times speed like I do for my audiobooks. If your brain can handle hearing Michael's voice sound like Mickey Mouse, you're welcome. But anyway, I'm super happy to have you here today. Thank you. I'm going to just throw it to you and let you go because I know you have some really good info that we want to learn today.
Yes. Thank you, everybody, for having me. Kimberly, I always enjoy networking with this group. And last week, for those of you that weren't on the call, and I imagine there's a couple, we went over a lot about bookkeeping, pro formas for your business. And I think the thing I did poorly last week was really give you guys the proper information to get some of those resources that I've created over the years. And I will do a better job of that at the end of this, so that if you guys want to use some of those spreadsheets that took me, a long time to put together, or pro formas, I think, I'd be happy to share those with you. And this week, I really wanted to get into the PLLC setup, For those of you that don't have one, I'm going to get into an in-depth discussion on S corporations, why S corporations are important, how to kind of set them up in kind of a macro level setup for those, and why you should have it, why you shouldn't have it. I'm going to do a little bit of depreciation on a rental property. I'll give you guys an example of that so you guys know what depreciation is. And then I'm going to give you a little bit of a nugget on cost segregation as it applies to bonus depreciation. And I think that is the one thing us as real estate agents don't know. 95% of CPAs don't know it really well. And it's something for you guys to really understand, because you guys are designated real estate professionals, which falls into a whole different tax category. So that's what I want to visit on today. And obviously I'll move as quickly as I can, just because I got a lot to cover in a short period of time. But also I want to do the best job I can to make sure that you guys understand what I'm going over. So let's, I'm going to share my screen here.
We can see it.
We can. Okay.
Yep.
So last week I had problems. Oh, yes. Okay. Just a reminder who I am. I also am an exchangeable. I'm a certified exchange specialist. I do 1031 exchanges. There's two things that I really focus on. And Kimberly was kind of talking about, hey, 2 or 3 things that you do really, really well. And you focus in on those. And 2 things I do really, really well. One of is being an exchange officer, a qualified intermediary all over the country. I travel all over the country teaching 1031 exchange to CPAs, real estate agents. I spend a lot of time in the room with tax attorneys. And so those are the people that and you guys are my key demographic of one of my channel accounts are real estate agents, both commercial and residential. And so that's what I primarily do. I do a lot of hard money lending, teaching that, and brokering that, and doing some of my own money that I've made over the years. So that's a little bit about me. Also been a broker for 21 years and closed a pile of thousands of transactions. So I have a perspective that like a tax professionals probably don't have, is that I really understand what you guys go through every day, and also the tax issues that come up in our industry, which nobody ever wants to talk about, but I talk about them a lot because I have owed the IRS $100,000 in back taxes before. So I know what it's like to dig out of that hole. So, so at any rate, let's get into it. Income from 2 buckets. I want to talk with you guys first about the taxes you pay. Well, we went over last time what taxes you pay if you sell a piece of property. In this case, where we get our income from. And it's important that we understand where we get our income from and what taxes we pay. So you really get income from 2 buckets. The first bucket is earned income. That's going to be your flips. That's going to be your commissions, your earned income. And on earned income, we're typically going to pay the thing that real estate agents have to do, since they're self-employed, is they have to pay their own FICA taxes, which is 15.3%. And that's the gotcha moment at the end of the year when you guys have to pay your taxes, which is coming up. So I'm hoping everybody's prepping for their taxes right now, getting all their information in. And filing your S corporation returns if you guys got those. There's federal taxes as well. We'll get into some graphs on that. And then state taxes. Good news, you're in Arizona. You don't have a very high state tax. There's other states that don't have state tax as well. So those are earned incomes. And then we have short-term and long-term capital gains. Earned income is short-term. So if you sell a stock within a year, you're paying ordinary income. It's also known as ordinary income. Long-term is any asset you hold over a year. We discussed that last week. Filings for, and these are a little bit out of date because they're adjusted for inflation, but long-term capital gains rates. This is if you're single, you have, most people will pay a 15% on long-term capital gains. If you make a high income earner, you're going to pay probably 20% in any stocks you sell within over a year, or real estate you sell. So these are kind of your long-term capital gains rates for assets that you hold. Okay. This changes if you're married. You're going to get kind of a double in some of these scenarios. 80,000. The 15% bracket starts at about 80,000. I think it's just at 85 now for inflation. I don't have the latest inflation adjusted income. So this is really good for elderly folks that are on Social Security and they sell stocks and they're married and they make $30,000 a year in Social Security and they sell $50,000 worth of stock. They don't have to pay taxes. This is really, really good thing for older non-income people. But for the rest of us that are earning income, you're probably going to be in the 15% tax bracket. And in some cases, you sell a big piece of property, you may fall into a portion of it as a progressive tax at 20%. So that's a little bit of background on long-term capital gains brackets. Here's your short-term. We're in a progressive tax system, and a lot of people ask me, well, I own an accounting firm, is they said, what's my tax bracket? Well, it's really a blended percent because each income bracket as you earn gets taxed at a different rate. So, for example, on this graph, we've got 24% between 168,000 and 321,000. If you're married, total combined joint income, you're going to pay 24% on that money. Every dollar I make above 321,000 takes me into the 32% bracket. And so it's progressively getting higher as more income that we make.
Michael, I'm paying 24% on that first amount, and then anything over that new amount above that is taxed at 32.
Yeah. Well, in the first 80,000, you're only going to get taxed at 12%.
Right.
The 80 to 168, you're going to get taxed at 22%. And so it's you're not going to get taxed at 24% on every dollar, you make to 321. You're going to
just in those thresholds, right?
Yeah. Progressive tax system is what we have for now in the United States. And this can catch up with you really quick. If you make $300,000 in commission, you're paying all of these percentages, and then they hit you 15% on the FICA taxes, which we'll talk about a little bit.
Right.
S corporation. So it's important that you kind of at least understand this on a macro level. I've gotten very micro in my career about this stuff. But for you guys, it's just on a macro level, you guys got to understand, hey, it's progressive. As each dollar I earn, it throws me into a new bracket. And some of the reasons why we need to have a SEP IRA set up, why we have to do some tax planning, because we do spend a lot of time planning our business for immense success. And I've seen that over the years. You start making this incredible amount of money if we do our jobs really, really well. But we do a poor job of planning how we're gonna not pay taxes, and so that's what we'll get into now a little bit too. So passive income is we talked about that. Rental income, stocks are going to be long term. Any asset you own over a year, and there's no self-employment taxes on passive income. So you're not on stock sales, you don't pay any self-employment taxes. That's just on active income. So let's get into a little bit about a PLLC, and then I'm going to go into an S corporation. The PLLC is the thing. I think it gets a little confusing because it has a P in front, and we go, well, what's the P stand for? The P just means professional limited liability company, is what that means. And in some industries, we're going to have the P. CPAs are where they're governed by an outside board. So the Board of Accountancy is going to cover CPAs, so you'll see the P in front of their name. Doctors, the medical board will have that. Attorneys, the state bar will govern those. For us, we have the Arizona Department of Real Estate. And so they tell us if we're going to open an LLC and we're going to receive commission through that LLC, it better be a PLLC. We want to see what that document looks like. We want to know who the members are. We want to know what the name of that PLLC is. So I've had clients set up PLLCs in the past, and they had like Kimberly Ryan Real Estate PLLC. And so the state will shut that down. They will say, we're not allowing that because it just has to be your first and last name or your last name and initial. And so they have some requirements when we set up a PLLC. And so a lot of you probably have those set up. A lot of you probably have those taxed as S corporations. So let's talk about an S corporation. You can't go to the Arizona, the Secretary of State and set up an S corporation. There's no place for that. There's an LLC, or there's a C, like what we call C corps corporations. You can only set up PLLCs, LLCs, and those C corps. The S corporation is a tax filing. And so, or tax status. So we elect to be taxed as an S corporation when we set up our PLLC. And so that's the most confusing thing for people is I want to set up an S corporation. Well, we're going to set up an LLC and we're going to elect to be taxed as an S corporation. And that does a couple of things that really helps us save on self-employment taxes, which I'm going to get to in a second here. But that also creates another filing that's due on March 15th. So your normal personal tax filings are due April 15th. If you have an S corporation, they're due on March 15th. And that's going to produce a K-1 for your income to be filed on your personal tax return. So you're not going to pay taxes on this corporation. It's going to get sifted through via a K-1 to your personal tax return. And at that point, you're going to pay taxes on it. So
Okay, slow down for a second, because I want to make sure that our brains are all absorbing this. Number one, you have a PLLC or an LLC, right? That you're electing to have taxed as if you are an S corporation. That S corporation then says you have a filing that's due by March 15th. That filing produces a K-1 that you include in your April 15th tax. Do I have it right?
1000%. Yeah.
Okay.
And one of the things I think we're going to get to why it's important and why it's important that you not set up an S corporation. So that's the second part of this is like, wait a second. I'm not making enough commission right now to set up an S corporation, or it doesn't make sense. And so I'm going to get to that too, because that's an important piece is like, wait a second, should I really be doing this? Should I be spending the money to set up an S corporation? I'm going to get to that too. But what I want you to really understand is why you would do it. If it was necessary, why would you set up an S corporation? And so
Perfect.
I'm going to give you an example of an LLC that's not taxed as an S corporation versus one that is. And I'm going to show you the tax savings in the two. This side-by-side comparison is the most powerful tool when I used to teach and own my accounting firm on why you would set up an S corporation. So if we just had an LLC or a PLLC that wasn't taxed as an S corporation, that's going to be a Schedule C on your tax return. And so in this case, we had a LLC making $100,000 net profit. That's after expenses. All this is after expenses, after you take all your deductions. So unfortunately, we got hit with a self-employment tax of 15.3%. So that's 15 grand right there. We had 15% federal tax rate. So that's going to be another 15,000. And then state tax. And in this case, our state taxes have dropped to 2.5% here in Arizona. But in another state, you might pay as high as 14%, 13% in California, for example. So I've just done this example. So we have a $35,000 tax liability on $100,000 in net profit. And you get that, oh my gosh, at the end of the year, right? Like, holy cow, how did my taxes get so high? Well, it's the self-employment taxes is really what's driving kind of that the amount we weren't expecting maybe. So if we took an LLC and we said we want to tax it as an S corporation, we take that $100,000 in profit and we break it into two different types of income. One is a distribution and one is a salary. So the IRS says if we start an S corporation, you must have a reasonable salary for its officers. Reasonable is a really interesting term. Right. So I always find that to kind of be, I remember this philosophy class I took in college, and it was absolute truth versus relative truth. we got nowhere on that discussion, although it was a fascinating, one of my favorite topics. And I think the older I get, the more relative truth there is, although I believe in some absolute truths myself. But my point is, what's reasonable to one person is not reasonable to another. And so we have found that a reasonable salaries in the tax CPA, tax attorney space, we have found that reasonable salary to be somewhere between 30 and 50% of our net profit. So, and then I asked a very close tax attorney, who was my tax attorney at the time when I owned the accounting firm. He was a prosecutor for the IRS in LA County for 10 years. So he was pretty, I said, Jason, I said, how many tax returns for real estate agents making $100,000 a year have they disputed the reasonable salary? He said, I haven't found one. So I feel comfortable being a reasonable salary as long as you guys keep it between 30 and 50%. I feel mildly comfortable with that. And I do as well, by the way. So in this case, we made a reasonable salary. We set up payroll through ADP or one of these companies, and we let them run our payroll. And we did pay self-employment taxes on this income. So you'll see we have the self-employment taxes, the federal taxes, and the state taxes of $12,000 in total taxes on that $35,000 reasonable salary. And an S corporation, one of the reasons why we set it up is to circumvent legally the self-employment taxes. So on the distribution, the $65,000 left over, and you may say, well, how do I take a distribution? A distribution in your PLLC to your personal account is just a transfer. There's nothing other than that. You're just moving money so that you can.
And there's nothing tricky you have to do about it. You can just transfer it.
Yeah, exactly. You can make a transfer. Notate your books appropriately, but and so this case, we were able to circumvent some of those self-employment taxes to the tune of about $10,000. So we had liability on an LLC versus a PLLC, which is taxed at an S corporation, or LLC taxed as an S corporation. We saved almost $10,000. And this is an S corporation, and that's why we do it. Is we circumvent some of those self-employment taxes, and if I'll play devil's advocate for a second. Well, wait a second. Doesn't that mean I'm going to get less Social Security because I'm paying less FICA taxes? Which I'll explain here in a second. But those are some of those are Social Security taxes. I would counter argue that and say take $10,000 and put it in some sort of savings account or into a flip or into your business. And I think you can exponentially grow before you could make the money back on Social Security. So just keep those things in mind.
Yeah.
So do we, real quick, I'll get into FICA and then I'm going to take some questions on that particular part. So like FICA taxes, 6.5% or 6.2% are paid by the employer. 6.2% is paid by the employee, normally in a W-2. That's why it doesn't hurt as bad when you're a W-2 employee. You don't see it as much. But when you're self-employed, you pay both sides. Okay. And then you got some Medicare tax. Those go away at 100. FICA taxes in at 140,000 per person. And then you pay 3% on anything above it. So FICA is not infinite. It doesn't go all the way 15.3% on all of your income, but it does for the first 140. I think it's 148,000 this year. And then Medicare taxes goes forever, however much money you save or how much you make. The savings with an S corporation can exponentially get lower as a percentage the more money you make, because it's not 12, it's not 13% forever. It's just 3% once you get to a certain tax bracket. And that may not make sense to you, and that's okay. Just know the FICA taxes are really some of the savings with an S corporation. I'm gonna end the breaking point. So we talk about like, well, wait a second, I'm not making that much money. I'm not making enough commissions, which, this is a tougher market too than we've seen. But I would say if you're making above $70,000, probably $60,000, $70,000 in net profit, you should consider and talk with your CPA about potentially doing an S corporation and having those things. I will say there's responsibility in that. There's an extra tax filings due March 15th. There's payroll fees that you're going to pay, probably $60 a month, $70 a month to do. And you got to stick with your salary. You got to keep that going. So there is some responsibility. If you're not going to handle the S corporation responsibly, I would suggest not doing it. But if you can see the value in it, and you can follow the rules of an S corporation, I think it's a worthwhile endeavor. So
okay, can I stop you for a couple questions?
Yeah. Sure.
All right. If I have a PLLC, do I need to have an S corp, or what's my other option?
Your other option is to keep it as a it will automatically stay as a disregarded
entity. Okay.
Yeah.
And if I do that, then that doesn't have any impact. I have a PLLC, terrific, but I'm not exercising any tax benefits to that. It just goes to my personal income tax and I have a disregarded entity, correct?
Yes, LLC, the PLLC offers some protection in the business that you do in real estate, but you could write off on a Schedule C, whether you had a PLLC or you were just doing a Schedule C right off of your income and expenses. The two are the same. The results of the taxes are the same.
Right.
Right.
So that's what I wanted to bring up, because
yeah.
if you guys are looking at, by the way, when you said 70 to 80,000 in net profit, by the way, that's not revenue. I want to make the distinction, right? So if you're earning 70,000, that doesn't mean the same thing as carrying profit at that level, correct?
Correct.
Okay.
Yeah.
I want clarification so everybody's brain gets the same thing.
When we think that, sometimes you know, I see a lot of agents making a lot of net you know, gross commission. By the time we pay all our bills, you know, I was always on 55% or so profitability myself. You know, I'd knock out 350,000 in gross commissions, and you know, I'd walk away with 180 after all my expenses and the Zillow ads and the, you know, and the assistant salary and everything that I had to do. So I found that to be, some people are a much higher percentage because they're doing everything themselves and they can run on a 80% profit margin.
Right.
But I'm kind of elaborating too much here. What Kimberly's point was is it net profit? It's net profit. After you
so I just want to make it clear that there are there are benefits to you having that PLLC or LLC that protect you, right, from litigation, right? There's some other, that's beyond the scope of our conversation, but there are benefits to you having that are not connected to the tax basis. So when you're looking at the screen that he has up right now, when he says there's responsibilities, right? The IRS filing, cost of payroll, and cost of the S Corp setup, and the fact that you have responsibilities to make sure you're doing these filings in March so that you have the appropriate stuff in April. Like, if that's not where you're at, that's fine, but that doesn't mean that you shouldn't have an LLC or a PLLC, just so that you're kind of all clear about that. I just, as we go along, I want to point out some other things, because Michael, you're hitting some really good parts that I think make our brains foggy if we don't fully understand. And sometimes we hear conflicting information, and really what we're hearing is just pieces of information that are part of the whole picture, but that's not getting communicated. So I'm just adding that piece to it.
And I appreciate that too. I think I don't expect you guys to go get your CPA's license and understand, but on a macro level, you should. Like, hey, S corporation is a good idea for some tax savings. Maybe I should talk to my CPA about setting it up and getting it done correctly. Bookkeeping, I think, is a great idea. Talk about to your bookkeeper, or invest in some time in learning how to keep your own books. Separating the business. The other important point, Kimberly, I think that is getting lost in this a little bit too, is the separation of your business, your PLLC, from your personal income. Right. And the commingling, although not illegal, terrible business practice of commingling your personal account with your commissions and your expenses, like getting those two things separated, and then having the software or the systems for tracking those profit and losses, those expenses and income as it relates to the software we're using, and doing that in our separated account, I think is a really good thing. And everybody kind of, I think all the classes I've taught over the years, and I've taught this PLLC class, and from a CE perspective, probably 80, 90 times over the years. And the thing I think people get really nervous about is like, well, and what if I need money to pay my bills? You can always transfer your money from the PLLC over to the personal and pay your personal bills. Keep all your business stuff on the PLLC side, and really draw a line between your business and your personal stuff. And I think that'll really help you keep track of things better. At the end of the year, it won't be so chaotic when you do those tax returns. So any questions? I want to open up anything about the S corporation that anybody's just curious about, or maybe I glazed over a little bit.
I have a question, Michael, and you may have answered it, but I just had to walk away from it to take a call. For my team, I want to be able to give a very succinct answer. Is there an amount, like if you're making 85,000, 90,000? Is there an amount that you can say like, this is kind of like where where you probably should do it?
Yeah, and Will, that is a terrific question. I get asked quite a bit. I feel like you get up to 60, 70,000 in net profit, you need to start having a conversation with your CPA about electing a tax, an S corporation. I think it'll depend on the individual too. Like if they have a W-2 income and they're paying all their FICA taxes, they have $150,000 salary, and I see this a lot, and then they go crank $100,000 in real estate commission or something, and I've seen that a lot. The advantages of the S corporation go down a little bit because they're paying all their FICA taxes, their self-employment taxes with W-2 salary, so the benefits aren't as much. So each situation is a little different, but in kind of simplified terms, it's really 60 to $70,000 in net profit. They should start thinking about this S corporation.
So if that's their only income and they're making 70,000, they need to start talking to someone about
Yeah, for sure. Yeah, because it maybe won't be the $10,000 savings that we talked about, but it might be $5,000. Well, shoot, you run 5,000, and your returns are 12%, and you're saving that money or putting it into, back into the business. It can be it can add up pretty quickly. So.
Thank you.
Yeah. Any other questions before I get into depreciation here?
I have a quick baby question. I'm new to this whole world, but when you were talking about the S corp and then you elect, 35 to whatever for salary, and then the rest of it goes into a different bank, not bank, but bucket.
Yeah.
What was that called? Disbursement or something?
Distribution. Yeah.
Distribution. What does that part look like? That just
so we make it sound really like it's some major event that happens where we have to do it through payroll, but it's really just transferring from the PLLC to your personal name. So what I would do, and still do to this day, is I have my monthly salary, and then I also have my monthly, I need to move to my personal account for bills or whatever, or to lend on the streets. So I do my salary, and then I go, I will need an extra 5,000, and then we just move it over to my personal account, and that becomes a distribution. So it's no more than nothing more complex than just a transfer of funds from the PLLC to the personal account.
Okay, thank you.
Yeah, and you could do multiple distributions in a month. I could do it every week if I wanted to. So just depending on what your liquidity position is, and what your bills are and all that kind of stuff. So.
Well, if you're looking at cash flow, like personally, so let's just take a quick example. If I close a deal and I have a $30,000 commission that rolls in, that goes into it gets paid to my PLLC, which is my business bank account. So here's my deposit of $30,000 sitting in my PLLC account. Well, I have to pay my personal mortgage, right? Like I can take 10 grand from there and transfer it over as a distribution into my personal account. No problem, right? It is literally that easy. It's notated in my transfer what it's for. It's my salary or however I have things. If I take it as a capital distribution, I can do it that way too, right? Actually, that's backwards. That goes the other way. Right?
No, well, distribution is you're moving money from the business to the.
So it literally is that easy. You can just transfer it from, like, $20,000 is still sitting in my business bank account, and I moved $10,000 into my personal. Right?
Absolutely.
Easy peasy.
Easy peasy. Yeah, we make it more complex. It sounds really complex.
Well, this is the thing that's tricky, and that's why I'm so glad you're here, is because we can just talk through these things and break down all the labels. Because you're going to talk about cost segregation. That just sounds like third-year accountancy conversations, and I don't want to talk about that because I don't know what came before in year 1 and year 2. But when we talk about cost segregation, bam, bam, shablam, it's a super easy conversation. It just sounds complicated. So my job is to take my swift sword and break these words down so we can get there. So hit it, Michael.
Yeah, for sure. Okay, let's get into depreciating. property. And then this will go into another section called cost segregation. But when we when we depreciate a rental property, I deal with depreciation a ton in 1031 because there's something called the depreciation recapture tax when you sell a property that nobody knows about. You're not going to do that when your personal property. There's no depreciation on a one you own. It's only on rental properties, perhaps second homes. Sometimes they're able to depreciate them. But depreciation is a powerful tool, and one that rich, high net worth people that own real estate use as a tool not to pay taxes. And I hear the argument, the rich don't pay their fair share, which in some cases probably may be a valid point, but they're using the tax code through depreciation. And so if you're a real estate developer, kind of like the president, and you're using cost aggregation to write off your income, and that's why people get infuriated without paying taxes. But we're using a tool called depreciation. And so in the rental property space, when you guys are representing or have rental properties yourselves, you're likely using a depreciation. On a residential property, it's 27.5 years you can depreciate the asset, which the IRS says eventually over 27.5 years, the asset's going to be worthless because we have to go and remodel it. You know, at some point we got to scrape these houses. I live adjacent to Arcadia here, and they're scraping houses left and right because eventually they're not worth anything. So yeah, Kimberly.
So depreciation, when you say 27.5 years, it is 27.5 years of ownership, not 27.5 years of age of property, correct?
Correct. Yeah. So from the date you put it into service, the date that you start depreciating it and say, hey, this is a rental property, you have 27.5 years to depreciate that.
So if my property is
On a
50
residential.
years old to start with, that's irrelevant, right?
It's irrelevant. Yep.
Day one, I bought it at 50 years and 1 day. Now I have 27.5 years that I can start depreciating.
Yeah, exactly. And that's not the land, that's just the improvements
That's
on the
be a
property,
pertinence,
right?
yeah.
Yeah, land you can't depreciate. In this case, I've taken a very simple example.
Okay.
$300,000 property. We're going to call it $100,000 in land value. And we can get in, I can teach a whole class on how you separate land value from improvements, but we're not going to do that today. We're going to go, improvements are worth 200,000. So that 200,000 we can depreciate over 27.5 years for a residential property. Commercial properties are 39.5 years or 39 years. I'm forgetting now. I actually need to know that by I think it's 39.5 if I'm not mistaken. So we're going to depreciate it, and we're going to say that depreciation, meaning we can write this money off against either our income or rental income on the property to the tune of $7,200. In this case, $72 per year, $600 a month, we can depreciate off of our income, our rental income. There's other things you can write off interest, repairs, some of the insurances that we carry on it, lots of stuff to get us. So when we're renting out a property and we have some sort of mortgage, even if it's at 50% of the value of the rent, meaning we have a mortgage for interest of $1,200, we're charging $2,400. This depreciation lets us write off the rest of the amount of money for the most part that we receive on the property. And so depreciation is a powerful tool, so we don't have to pay income on some of that against our rental income on that. And so that's really depreciation. It's very, very simple. It's the improvements of the property. We're dividing it by 27.5 years, and then that's what we get to deduct. And so over the years of owning a property, the more depreciation we take over 15 years of the property, that may get if we ever sell the property, there's something called depreciation recapture, which I'm not teaching today, but that is a tax that gets deferred with 1031 exchange. And one of the reasons why by doing a 1031 exchange is such a powerful thing. So this is investment properties only. And another reason why you can talk an investor into doing a 1031 exchange, for you guys, it's a really good part of your business because you get 2 sales out of it in a very short period of time.
Right.
You get the long-term capital gains, but don't forget about the depreciation recapture. How long have you been depreciating the asset? 20 years, a lot of recapture. And that is taxed at 25% is depreciation recapture. So, but I'm not gonna get into that. So let's take, I'm gonna take this and we're gonna do a cost segregation on the property instead. So cost segregation, I don't have a slide on this, so you guys will have to bear with me on this. So in a cost segregation study, we take the same school of thought of depreciation, and we go, we're going to take the property that's $300,000, and we're going to do a cost segregation. And so what we do in a cost segregation report is we pull apart all of the instruments inside the home and depreciate them at an accelerated rate. For example, we took a kitchen. A kitchen's not going to last 27 and a half years. We pull that out and depreciate it. The carpet's not going to last 27 and a half years. So we're going to pull all that out. When we do a cost segregation report, in this case, $300,000 property, we can usually pull 25% of the value of the property out of cost segregation. So 25% of 300,000 is, my math is terrible, 75. Let's call it 80,000. We can take that $80,000 and we can pull that out on a cost segregation report. And if you're a real estate professional, you can deduct that right off of your income. And so that's a poor example of 300,000. But if we bought $1 million property and we did a cost segregation study on it and pulled out 25% of the value of $1 million property, it's $250,000. We then take that off against our income because we're designated real estate professionals and write it a good portion of that off. Yeah.
Can I make a comment on that, Michael?
Yeah.
So I've been in real estate almost 30 years, and I learned this about 5 years ago at a Brett Tanner event, which just means I was dumb for 25 years.
Yep, me too.
But literally this thing changed my life, because year one, I mean, that year that I learned it, going back the year before, I was like, oh, I just bought this $500,000 property. And it literally saved me $100,000 in taxes that year. So I said, so if I either pay $100,000 to the government every year, or I could just buy this $500,000 or $600,000 property every year and use that $100,000 to put the down payment. They're like, yep, exactly. And literally for the last 5 years, that's what I've been doing. I mean, it was amazing.
Will, once you figure this out as a real estate professional, you're either going to give $100,000 to the government, or you're going to put $100,000 down on a property and have it, a great asset that's hopefully cash flowing. It's tougher to do. It's tougher to do in this environment, but you guys could do some subject to stuff. You guys could do some owner financing, get that rate down. You could do some rate buy downs. But you writing a check to the government for $100,000 is the worst decision you'll ever make. Because you guys are designated real estate professionals, you can use cost segregation against your income, your commissions. And it's a powerful, powerful tool. So I could teach a whole class on cost segregation. I'm not doing that today because we have 1 minute. But you guys need to, okay, so write this down. The gentleman's name is Toby Mathis. He's a tax attorney. He's the best, in my opinion, the best cost segregation tax attorney in the country. He runs Anderson Advisors out of Las Vegas. Toby Mathis, and his research, or just type in to YouTube cost segregation Toby Mathis, and his video will come up. It's a 30-minute video, I think, 40-minute video. He goes over in depth of cost segregation. You guys should know this. If you guys have a real estate license, you need to know cost segregation and the benefits of depreciation and how you guys will use those. I expect the administration to advance and extend some of the benefits of bonus depreciation. I expect that to happen probably in the next 12 months or something. That's, I'm out of time, but that I'll leave you with, is just to learn that a little bit better. And, Will's using it in his business. As you guys start to make any type of money in real estate, you need to start using it every year. Buy a new property every year.
Yeah, can I say something around this? Oh, go ahead, Will.
Just one more question. When I'm explaining this to my agents and other people that could be considered real estate professionals, but they're technically not, they don't have a real estate license, what is the reason that you tell them, like, if you're not a real estate professional, you can only deduct a certain amount of loss? What's that loss? Like, is it like $3,000 a year or $4,000 a year of that type of income?
Well, it depends on their income bracket, depends on their profession, there's a lot of depends.
All right, well then we'll ask that for another time.
Yeah, no, but there are some benefits to cost segregation for, it's difficult to write off against W-2 income.
Yeah.
So, and it's right, you're right, Will, it's limited. So if there are W-2, if there are two doctors receiving W-2 income, it becomes more challenging to really get the benefits of what we're doing. But if they're a real estate investor, and that's what they do, and you land a couple of real estate investors, that's what these guys do.
And if they don't have another job, they can be a real estate professional, because that's all.
Oh, for sure. X amount of hours doing business, a good portion of their income comes from it. 100%. If they have a real estate license, pretty good chance you could get away with it too. Yeah. So there's some things that they can do, but that's a great question. W-2 employees are tough. They just don't get the same deductions we do,
Right.
So.
The last thing I wanted to just share around this is you talked about how, the wealthy don't pay taxes. And it's so funny. I laughed when you said it, because I just had this big conversation about it yesterday morning with some people. And I think what happens is people don't understand how that is, right? Like, you shared a big portion of this, but the people who are wealthy aren't earning, they're not income earners, right? They're just borrowing against their own, they're borrowing against their own assets, and you don't pay taxes on loans, right? And so people don't understand that they're really just borrowing against what they've built. So when we take this cost segregation conversation and we listen to what Will is doing in his business, Will is building wealth from which he can borrow and take money from his own assets to live on. He doesn't need an income. Now, maybe he's not there yet. I mean, maybe he's Trump, maybe he's not. I don't know that much, but I'm just saying that's the concept, right? And so when we talk about this and we're like all wounded that, when, what's his name, Warren Buffett says my secretary pays more taxes, I feel like, well, you're kind of a loser. You're not paying her enough to buy property to build assets. That says more about you than her, right? But the point is, he's paying fewer taxes because he's not earning income. He's living off the value of assets. And so when we take these advantage of these benefits right now, as we're earning income as real estate agents, and we're dumping that money through cost segregation back into an additional property versus paying the government, you're never going to get ahead when you're paying the government. It's just not going to happen, right? But if you are spending that money and throwing that into additional properties, what you're doing is you're building a future toward not needing to be an income earner. If you're not an income earner, you're not paying income tax, but you have access to the wealth that you've built, and you can borrow against those properties. So that's a really simple, probably an oversimplification of the IRS tax code, but it's all super legal. That's what the IRS tax code has given us. We just are woefully ignorant of the benefits that are available to us. These guys that are multi-billionaires, people have figured out the value of that, 2,000 page IRS code. So before you get angry, you have to understand you have the same opportunity.
I wish I could rewind and record everything you just said. It was so easy to understand.
It is recorded.
I meant like I want it on my phone. So the next time I hear somebody BMC about the wealthy don't pay taxes, I'm gonna excuse me, wait, you need to hear something.
Well, then go to
that
the recording.
Was just so perfect and simple.
Thank you.
Let me say this. They are incentivizing us to do activities.
Absolutely.
The IRS. They're incentivizing us to invest in America and to hold stocks for longer than a year. They're they're incentivizing us to buy real estate and hold. That is what they're incentivizing us to do. So that is what we need to do, because those things are really good. Warren Buffett, he pays, a 20% tax and some other taxes that go with it, because he's held stocks for a really long time, which is a low tax rate, right?
Right.
Because they're incentivizing us to hold real estate, hold taxes, invest in America. And so we have to just go, that's what they're incentivizing us to do. That's what we want to do. And it's really good for us too, because it's going to grow our wealth. So with that said,
it's not political, because regardless of who's in office, they're making incentives in some way. We just have to know what those incentives are, regardless of who's in there, and start going that direction.
Yep, exactly.
Yeah. So hopefully, you guys, this has been super helpful. Michael, I know people had to bounce at the top of the hour, but super appreciate your time, effort, energy. Would love to have you back to talk 1031 exchange so that we can teach people how to do that. maybe we could do an in-person on that, because I feel like that needs like face-to-face whiteboard action on it. So maybe we'll do a 1031 soon. Super appreciative of you and your time and your knowledge. Thank you so much. I'm so
I
grateful.
was just going to, I was going to pop up on my my
Oh yeah,
contact
do that so we
information.
can get connected.
Email, if you guys want a copy of that pro forma, if you want a copy of the slide deck for perhaps, if you just want to talk to me sometimes about stuff. I mean, I'm a great knowledge for 1031 is what I do, but I know the tax code pretty well too, just owning accounting for so many years and working with CPAs. And, you know, I'm on the phone with my tax attorney, 3 times a week usually. So going over some of the scenarios that happen. So I'm always happy to help, because you guys are really my customers at the end of the day, and you probably know some people that maybe need it. So I'm always willing to share as much information as I can, or point you in the right resource of where to get the information. But if at any rate, if you guys need me, I'm here for you. And so
Thank you.
So there's my contact info. So.
Yeah, and if you're ever over your head in a conversation around 1031 where somebody knows a little bit and you know a little bit, but you need the big picture, Michael's 100% your guy. So if you hear of any of your investors or you hear other agents talking about it, he's a really good resource for you. Sometimes it's just great to be the source of the source. So thank you so much, all y'all. Hope you have a super happy week.
See you guys.
Bye, guys.